What if I told you that free trading isn't really free? No fees, no commissions, just you, your phone, and the stock market. That's the promise that changed investing forever, and the catch that most people still don't see. When Robinhood launched in 2015, it promised to democratize finance. For decades, traditional brokers charged you a few bucks every time you bought or sold a stock. Then came the big disruptor, zero commission trading. Millions of new investors poured in, the idea sounded pure, free markets for all, but behind that clean interface was something more complicated. A hidden system that still makes someone very rich. Here's the secret sauce: payment for order flow. Every time you hit buy or sell, your trade doesn't go straight to the market. It goes to big firms like Citadel Securities or Virtu Financial. They execute the trade and they pay your broker, like Robinhood, for sending it to them. Tiny amounts per trade, but across millions of users, it's a goldmine. In 2024 alone, Robinhood made over $1.6 billion from these transaction fees. Regulators call it a conflict of interest, because if your broker gets paid more by one market maker than another, whose interests do they serve? Yours or theirs? Even the SEC chair, Gary Gensler, said it best: zero commission doesn't mean zero cost. Still, to be fair, studies show that overall costs for retail investors did drop after commissions disappeared. So it's not a scam, it's just not as free as it looks. Free trades don't keep the lights on. So where does the rest of the money come from? Let's break it down. Interest on idle cash. If you leave money sitting in your account, Robinhood earns interest by parking it in partner banks. Margin and securities lending. If you borrow to trade, you pay them interest. And they can even lend your shares to short sellers. Subscriptions. Their Robinhood Gold plan, $5 a month for premium tools. All that added up to over $1.1 billion in 2024 alone. That's the real engine behind free trading. There's another piece to this story: behavioral design. These apps don't just let you trade, they make you want to trade. Push notifications, price draws, flashing alerts. It's called gamification, turning investing into something that feels like a video game. And it works. Research shows it makes people trade more often and take bigger risks, especially younger users. Remember when Robinhood used to throw confetti every time you made a trade? Yeah, they had to remove that in 2021 after public backlash. Because here's the truth: the more you trade, the more they earn. This model isn't just American anymore. From Europe to Asia, brokers are racing to launch commission-free platforms. And they're winning. In Russia, digital brokers outperformed traditional banks thanks to speed, accessibility, and tech. But regulators are worried. If everyone's using gamified apps built around engagement, how do we keep markets fair, rational, and transparent? Here's the paradox. Yes, commission-free trading lowered barriers, but it also blurred the line between service and surveillance. You're not paying with money up front, you're paying with data, your habits, your behavior, your clicks. They fuel the algorithms that keep you trading, and them profiting. Still, on balance, the system has worked for most investors. Even after accounting for small hidden costs, trading today is cheaper and easier than ever before. As long as you understand the mechanics, you can use them instead of being used by them. Commission-free trading changed everything. It made investing simple, social, and accessible. But remember, when something's free, you're probably the product. Transparency is key. Know how your broker makes money, and you'll make smarter choices with yours. If you found this breakdown useful, hit like, share, and subscribe for more stories about how modern finance really works. Until next time, trade smart, stay curious, and read the fine print.